Prediction: Opendoor will not be able to keep its gains over the long term. This is an article I'm going to read you from the Mötley Fool. This is not my opinion. One of the hottest stocks of this year has been Opendoor, which is up more than 500% year to date as of this writing. The stock recently shot up nearly 80% in one day after the company announced both a new CEO and that its founders were returning to the seats of its board of directors. However, the stock's rise this year is not because of the strength of its business or signs of a turnaround. In fact, the stock saw its share price actually cut in half earlier this year before hedge fund manager Eric Jackson of EMJ Capital started hyping the stock on social media platform X, formerly Twitter, in July, saying it had the potential to be a 100-bagger. Others piled in, including me. With the high short interest and retail investors jumping in, the stock skyrocketed despite poor results. A struggling business? Opendoor is essentially a company that flips houses. It uses a proprietary algorithm to act as an instant buyer of homes, making all-cash offers to sellers. While the company typically offers somewhat lower amounts than what a home is worth, the allure to sellers is that it's a quick sale. The company makes money in two primary ways. By the way, I think the new CEO is going to make it much more than two ways in the future. The first revenue stream is through flipping the house, where it makes repairs and sells it at a higher price. It charges a service fee, which it says is akin to a realtor's commission. It's also been working to expand its businesses in a more comprehensive platform, offering services such as mortgage services and title insurance. Finally, the biggest issue with Opendoor's model is that the company takes on significant inventory risk. Once it buys a home, it owns the home. These things aren't cheap. The process exposes Opendoor to losses if a house sits too long, since it has to pay real estate taxes and other costs like utilities. Meanwhile, home prices can also fall. The model can work in a rising price environment, but in a tough real estate environment, it can be challenging. We know the last 2 years for the real estate market has not been great. This is a low gross margin business, and gross margin slipped by 30 basis points to 8.2%. It's talking about recent earnings. It recorded a net loss of $29 million in the quarter, but positive adjusted EBITDA of $23 million. That's actually pretty good news in a really tough real estate environment. However, the company offered a cautious outlook going forward due to what it called a deteriorating housing market. Hopefully the Fed interest rate cuts helps this out. It said consistently high mortgage rates are leading to less buyer demand, resulting in both fewer acquisitions and lower resale volumes. You got to remember, if the interest rates are high, Opendoor can't buy the houses because people aren't selling the houses and they can't move. The company only purchased 1,757 homes in the second quarter, which was down 63% versus a year ago.